Hi everyone. So welcome to the stream today. Very much excited for having you on day 2 in our series of the Executive Revision Masterclass with Nhyira Premium. Yesterday was really epic. We looked at various things in relation to relevant costing decision, and I also answered a lot of questions on various issues relating to the topic in that case. And we want to continue with that today and look at relevant costing too, as well as consider some short-term decisions today. So still we are looking at management accounting. We are looking at the issue in relation to relevant costing, the issues in relation to short-term decisions. These are very critical issues in your syllabus that you have to look at because they are fundamental. So if you join the stream, you comment in the chat box with all of your questions and give us a thumbs up on the video because that way the video gets more engagement, and that is the way YouTube will be able to push the video to other people so that they can also watch, and we will be able to together grow the channel well. And in case you've not subscribed also, you can subscribe to the channel and hit the notification bell. But hey, welcome to the stream today. Very much excited about it, and we want to look at it and go into it real quick. Okay, so I see thumbs up on the videos. That's great. Put your questions in the chat box, anything relating to management accounting or maybe other issues that you want me to share my thoughts on. You can put it in the chat box. I'm going to be answering all of your questions for you. And then if you can also share the video on your WhatsApp platforms, on your Facebook pages also, why not share it, and then let's get as much people watching the stream as possible so that challenge together we can assist a lot of students just like you to pass their examinations and take their life to the next level. So these are two key things that we'll be looking at today: relevant costing analysis 2, and then short-term decisions making, definitely for ACCA F2, ACCA F5, management accounting in ICA or ICAG, and then introduction to management accounting. The relevant costing aspect, it's critical in relation to that. So let's do a quick recap on what we did yesterday. Just a quick recap. Yesterday, just a quick recap on relevant costing analysis. We made mention of the fact that when it comes to relevant costing, relevant costing analysis for special order pricing decisions, we look at the relevant cost we are incurring in undertaking the project or in meeting the special order. And so we distinguish between what is a relevant cost, what is a relevant cost, and what is an irrelevant or non-relevant cost. So these two distinctions we made was the fact that relevant cost must be future cost. I believe you remember that. So they must be related to the future. Number 2, we said it has to be an incremental cost. All right. Then number 3, we made mention of the fact that it has to be a variable cost. All right. And then the 4th thing we said is that it has to be so future cost, incremental cost, variable cost. Then the 4th thing we said was that it should be an avoidable cost. So I'm putting that above here. Should be an avoidable cost. What it means is that had it not been for the project, we wouldn't have incurred that cost. That is why it is called avoidable cost. So that was the distinction we made there. Now, when we said that anything aside this will be categorized as irrelevant cost. So issues in relation to non-cash items like depreciation, amortization, provisions, these are non-cash items. Then sunk costs, we said these are costs that you incur in the past. They are irrelevant. We don't consider them. So the book value of an asset, the historical cost or the price at which we bought something some time ago is a sunk cost. It is irrelevant. We don't consider it when we are making any decision about relevant costing. Then another thing we also mentioned, and I'm putting that above there also, it's committed cost. So these are also costs that we have incurred in the past, which whether we undertake this project or not, we will still going to be, or we had already incurred it, so it has no impact on us in relation to that. So we distinguish between relevant cost and then irrelevant cost. So we mentioned that relevant cost must be future cost, relevant cost must be incremental cost, relevant cost must be variable cost, relevant cost must be avoidable cost. And in a nutshell, we said that relevant cost must be cash flow, all right, future cash flows. That is what we mean by the relevant cost. Now, after we looked at this, we went through the question tag for identifying the relevant cost of material as well as relevant cost of labor. Now, when it comes to relevant cost of material, you remember the question tag we went into, right? I'm not going to be going through it today, just a quick revision on that. Question one, we ask ourselves, is the material in stock? That's the first question we ask. Now, then I said there are two answers that can be given. Either yes, it is in stock, or no, it is not in stock. Now, if no, it is not in stock, then the relevant cost will become the purchase price. Because if I need a material for a job and I don't already have it, that means that the relevant cost will become what? The purchases price in relation to that. But if the inventory or the material is already in stock, then we ask ourselves another question. That is it in constant use? So we have it in stock, yes. Is it in constant use? That is the second question we ask ourselves. So is it in constant use? Again, two answers can come up. Yes, it is in constant use. No, it is not in constant use. Now, if it is not in constant use, listen to this carefully. If it is not in constant use, that means that we have to ask ourselves another question. But if yes, it is in constant use, that means if we use it for this project, what do we have to do? We need to replace it. For that reason, the relevant cost is the replacement cost because it is in constant use. But if it is not in constant use, we ask ourselves the third and final question, and that is going to be, does it have an alternative use? Okay, this material, it's our material. This material is what we are using in our organization. Yes, it is not in constant use, but does it have an alternative use? Does it have an alternative use? If it has an alternative use, that means that if we don't use it for this project, we will use it for that event. And then because we are using it for this project, we cannot use it for that other thing. For that reason, the relevant cost becomes what? The opportunity cost in relation to that. Or better still, maybe it has no direct alternative use, but we could sell it for a revenue. So if we use it for this particular project, we use it for the order, it means we cannot sell it. So since we cannot sell it, it means that the relevant cost becomes what? The lost revenue, which is still the opportunity cost. But we mentioned that if it has no alternative use, then certainly the relevant cost is going to be nil in relation to that. However, I made mention of the fact also that the fact that it has no use, sometimes it has to be disposed of. So if we have to dispose it of and incur a cost on the disposal, that means that using it for this project, the relevant cost will become what? The disposal cost, which is actually a cost savings to us as an organization, should we use it for this particular project in relation to that. So that was what we mentioned when it comes to identification of the, or determination of relevant cost of material. Right, I see a comment coming from Augustine. He said, good day, comrades. Yeah, a good day, Augustine. Guess you're doing well. Welcome to the stream. And for those of you who have also joined the stream, very much excited for having you. Whatever question you have, put it in the chat box and consider sharing the video as well so we can get as much people watching the stream as possible. If you have not, give us a thumbs up on the video. That way it gets more engagement and YouTube will be able to push it so that other people on the platform can watch it and also study and understand well. So how do we determine the relevant cost of labor? So when it comes to relevant cost of labor, what do we do? With relevant cost of labor, this is what happens. We ask ourselves still three key questions. You remember that, right? So first, are they permanently employed? So the employees we have, are they permanently employed? Two answers all the time. No, they aren't permanently employed. Yes, they are permanently employed. So we mentioned that if no, they aren't permanently employed, what then do we do? We have to now employ them on this special order, on this special job. For that reason, the relevant cost becomes what? The hourly rates that we are going to be paying them. But if yes, labor is permanently employed, we ask ourselves the second question. What's the second question? The second question is there spare capacity or is there an ideal time? Right, because sometimes we have permanently employed people, they are on a fixed salary, but there are times when they are not doing anything. Either they are just there chatting, doing social media, watching other things on YouTube and other stuff. So there is idle time. In that case, we need to find out how we can use them for the no job. So is there idle time? Yes, there is idle time. No, there is no idle time. Now, if yes, there is an idle time, then the relevant cost is going to be what? Zero. It's going to be nil because we have already employed them as full-time employees. They are on a salary scale. They are on our payroll, but there is a time that they aren't doing anything. For that reason, what do? We engage them on this new job. So if there is a spare time, there is a spare capacity, there is an ideal time, then the relevant cost is going to be nil. Then we said, if there is no spare time, meaning labor is fully utilized, then in that case, we ask ourselves the third and final question, and that is overtime possible? Right, the employees we have, can they do overtime? Are they people who will be saying, all right, we're supposed to close 6 p.m., but because of the special order, we are ready to work for some 3 hours, 4 hours in that case. So is overtime possible? Two answers as always. Yes, overtime is possible. No, overtime is not possible. So if yes, overtime is possible, what do we say? In that case, we say that we are going to be paying them their basic wage plus the overtime premium. So in that case, the relevant cost becomes the basic wage plus overtime premium. But if they cannot do overtime, what do we do then? Two options. Either we outsource the job and then bring in extra staff to come and do the job. In that case, we'll pay them the hourly rates due to be paid. And then either we do that option or we take our existing employees from the current job that they are fully utilized on to the new contract. But remember, anytime you move your labor who is already doing something, there is going to be a lost contribution or there may be a penalty. So that movement is going to result into opportunity cost. In addition to the opportunity cost, the lost contribution or the penalty, you are going to pay them their basic wage in relation to that. So this is what we discussed yesterday, just briefly, to just bring back what you learned yesterday. Because of the question we're going to solve today, I needed to do that. So that's how we determine the relevant cost of material and then relevant cost of labor. From there, we looked at a couple of questions, and we're going to be building up with some of the questions as well today as we continue with our discussion. So if you have any questions, you know what to do. You put it in the chat box. Okay, I see a comment from Augustine. Please, what's your Zoom ID? Augustine, this meeting, like I'm not allowing people to join on the Zoom. So that's why we are not sharing the meeting ID. I'm just using it to be able to stream the stream on YouTube. So That is why we solely allow people to be watching on the YouTube. So this one, we are not allowing people to be on the stream. So if you have any comments, you just put it in the chat box and I'll be reading them for you. Okay, so let's get into our question, our next question. Let me share my screen with you. Okay, so Augustine said, okay, thanks, you're welcome. So let's look at our next question. Yep, this one. Comment in the chat box with all of your questions and give us a thumbs up on the video, okay? So let's look at the next question, and that is question 4. Remember yesterday we solved 3 questions. This is the 4th one we are solving. After this, we will take a full relevant costing decision question, and then you see how we go about it. So let's go. A business rents a factory for $60,000 per annum. Only half of the space is currently used, and the company is considering installing a new machine in the unused part. So you can take a screenshot, okay, of the question. The machine would cost $2.1 million, be depreciated over 10 years at $200 per annum, and then be sold for $100,000. The company would insure the new machine against damage for $5,000 per annum. Okay. The requirements of the question is, what are the relevant costs of the new machine purchases or purchase? What are the relevant costs of the new machine purchase? So I believe you got a question. A business rents a factory for $60,000 per annum. Now, immediately you read a question or you start reading the question, you have to get what is the relevant and what is the irrelevant. That's what I always tell you guys, right? So the rental for the factory is not a relevant cost. Whether we install the new machine or we don't install the new machine, the rental for the factory will still be paid. All right, will still be paid. So the 60,000 per annum, the rent for the factory is irrelevant cost. Only half of the floor is currently used by the company. Only half of the floor is currently used, and the company is considering installing a new machine in the unused part. So like I said, the factory rent of 60,000 per annum is not a relevant cost. Now let's see. The machine would cost $2.1 million. Okay. Remember, the requirement of the question is, what are the relevant costs of the new machine? So we've seen that the cost of the machine to be bought, $2.1 million, is a relevant cost. Be depreciated over 10 years at $200,000 per annum. Again, depreciation is a non-cash item, isn't it? So that $200,000 there is an irrelevant cost. And sold for $100,000. Okay, so at the end of its useful life, it will be sold for what? $100,000. That is the scrap value of the asset. That is a relevant cash flow item that we need to consider. The company would insure the new machine against the damage for $5,000 per annum. So the insurance cost about or on the new machine is also going to be a relevant cost. I hope it makes sense. So what is the relevant cost in the question here? Let's highlight it out. So the cost of the machine, $2.1 million here, is a relevant cost. the annual insurance that we are going to be paying, which is the $5,000, is also going to be a relevant cost in that case. Then, like I said, the scrap value is a relevant cash flow item as well that we have to consider. But in that question, the examiner said, what are the relevant costs of the new machine? So the relevant cost of the new machine is going to be the cost of the machine, $2.1 million, as well as the insurance cost in relation to that. So that is how we're going to be answering that question. So relevant cost of the machine purchase, let's look at it. Of the new machine purchase will be the cost of the machine which is 2.1 million, as well as the insurance, which is $5,000 per annum. So that is the relevant cost for the new machine. In this case, we're not going to be adding anything because the question is not complete. We don't have the total revenue that we're going to be generating on the machine. So assuming we have the total revenue or the contribution to be generated on the machine, then we would compare that with the cost that we are incurring to find out whether the net benefit is positive or the net benefit is negative. Then we could decide whether we should buy the machine or we shouldn't buy the machine. But in this context, our relevant cost will be the machine cost as well as the insurance cost that we are paying. Remember, the annual rental, like I said, it's a sunk cost because we have incurred that cost and we will continue to pay it whether we install this new machine or not. So that is irrelevant. And then the depreciation is also going to be irrelevant in relation to that. So Augustine said, I thought the sale value will be considered to mitigate the entire cost of the machine. No, we will, yes, it could mitigate it, but the revenue generation of the machine is not available. So if that is available, then we could add this scrap value to the revenue generation of the machine as well. Then we can make the final decision in relation to that. So because you know this insurance is per annum, so it has to also be multiplied by the number of years. From the question, we can infer that the number of years of the asset is going to be 10 years. So it should be 5 by 10. But the revenue generation or the contribution to be generated on the asset is not available. For that reason, the scrap value will not come in because in the question, we are supposed to just look at the relevant cost that we are going to be having for this machine. So the cost component of the machine will be the actual cost of $2.5 million and then the insurance of $5,000 per annum. So Augustine, I believe you get a difference, you get a concept in relation to that. All right. So now that we've built a couple of understanding concerning the relevant costing, let's look at a fully fledged relevant cost decision, and let's find out how we can use these principles together to assist an organization to make the decision actually. All right. So let's look at how we put the pieces together. So we're going to be looking at a full question here. And you're going to be taking a screenshot, all right? Or maybe write as I explain it. I'm going to share my screen with you in a moment. So we go there. John Edu said, please, why was the selling cost not a relevant cost? We were not having selling cost, John. We were having the sales, that it can be sold for, where is that? Let's go back. So this is it. So it can be sold for 100,000 US dollars. So like I said, the question said we should just look at the relevant cost of the new machine purchases. The scrap value of the machine is a revenue component, not a cost component. And like I said, we don't have the revenue or the contribution we are generating from the machine. So even though that is a relevant item, we are not going to be considering it here because the examiner said, what are the relevant costs of the new machine? So the relevant costs in this context will be the cost of the machine purchases as well as the insurance cost in relation to that. So John Edu, I believe you understand. Okay. So let's look at our next question. So what I want you to do is either you pick a screenshot or you're gonna be writing as fast as possible, but I guess the screenshot will be great. So you can write later on as I explain it. So this is a full relevant costing question. Let's scroll down to the requirements as always, so that we know what we're doing. So the requirement of the question actually starts somewhere here, the last paragraph. So we are told that the managing director has heard that for special orders such as this, relevant costing should be used that also incorporates opportunity costs. She has approached you to create a revised cost schedule based on relevant costing principles. So you have been approached by the managing director of the company to prepare a revised cost schedule, taking into consideration what? The relevant costing principles. So look at the requirements. Advise the schedule prepared by the accountant to a relevant cost basis, incorporating appropriate opportunity costs. So let's go back to the beginning of the question, and then we set it out. So the managing director of Passe Limited, a small business, is considering taking on a one-off contract and has asked her inexperienced accountant to advise on what costs are likely to be incurred so that she can price at a profit. Okay, so there is a one-off contract that Passe Limited has received, and the managing director asked, funny enough, an inexperienced accountant to prepare a cost schedule. That's why you are coming in as a consultant, because the inexperienced accountant just slash in figures without taking into consideration relevant costing principles. So the following schedule has been prepared. Cost for special order. So we have direct wages, note 1, supervisor's cost, general overheads, machine depreciation, machine overheads, materials. So based on the inexperienced accountant's cost schedule, the total cost is 98,300. But like I said, she did not consider relevant costing as well as any opportunity cost. So that is the cost schedule we have there. And you can see the footnotes there, and we're not gonna read all the footnotes at once. We're gonna take the footnotes one after the other and work it out one after the other. So let's see. The first thing I want to do, even before we start going through, is to show you how we can set out the pro forma for the question. So how do we set out the pro forma when answering relevant costing questions? So let's look at it. Don't worry, I'm going to share back for you to see the question. I want to show you the pro forma of how we solve the question. So for Passe Limited, as always, we put the name of the business up. So we're going to have a working sheet. So I'm dividing my screen into two. And then we will have the cost sheet on one side, certainly revised cost sheet or the cost card on one side. Then we're going to have three columns, sorry. We're going to have items. We're going to have notes in the middle. And then we're going to have the currency. So these are the three columns we're going to deal with. Then on my next page, I'm going to have the notes here, which is going to be like workings and all of those. Now, the notes there is to explain to us why we think something is relevant. Okay, so please put this layout down, because when I share the question back, I'm not going to have this again. I'm going to start from scratch. So the cost items will be listed the way it has been given in the question. So we have direct wages. Certainly that will be note 1, and we will set out our workings here. Supervisors cost, that will be note 2. We will set out our workings here. General overhead, that will be note 3. We will set out our workings here. Then whatever figure we have based on the relevant costing will be recorded here at the cash column or the currency column, respectively. So this is the workings outline for every relevant costing decision. Please take note of it, because this is how you will be doing in the exam, or you will be doing it in the exam. So you have the name of the company above. You have the cost sheet or the cost card on the one bit. Now, you are using a book, so the cost sheet can be above. Then you leave a space, 2-3 lines, and then the notes can be below. Or better still, the cost sheet can be on the front, and then on the next page, the notes can be there in relation to that. I hope you get it. So let's see how we go about it. Are you done with your pro forma? So put down the pro forma real quick that you have here, and let's go back to the question. So if you join the stream, we are looking at relevant costing analysis, and we will get into short-term decisions. Comment in the chat box with any questions that you have. I'll be reading all of your comments and answer them. And consider to give us a thumbs up on the video. That way it gets more engagement, and YouTube will be able to push it to others so they can also watch, and we can grow the channel. And in case you've not subscribed, also subscribe to the channel and hit the notification bell icon, so that if I go live, you'll be the first person to be notified, or when we release content, you'll be the first person to be notified, so you can study under my mentorship to prepare well and pass your examination. So give us a thumbs up on the video. All of you, if you can, give us a thumbs up on the video. Okay, so I believe you've put down the pro forma for this. Now I'm going to go back to share the questions, and we take it one after the other in relation to that. So the first item we see there is about the direct wages. And I want you to listen to this carefully. Okay, I want you to listen to this carefully. When the direct wages, we saw that the inexperienced accountant has recorded that the direct wages should be 28,500. 28,500. That is the first cost item there, and that is in note 1. So we're going to read the note 1 and give an explanation on what has to be done about it. Now, remember what I told you yesterday. If your English is poor, you will struggle in management accounting. And when we talk about English here, you're not talking about your preparatory school English or your Montessori English. We are talking about the management accountant's language and understanding the language. That's what we mean here. So you got to make sure that you read the question carefully, get what the question is stating, so you can decide what really is happening. I hope you get it. Richard AJ, okay, I see you with a thumbs up in the chat box. So let's go to the footnote 1. Now, immediately you read the question, you read the notes, you should be able to know what is the relevant cost and what is the irrelevant cost. So let's go. Direct wages comprise the wages of 2 employees, particularly skilled in the labor process for this job, who could be transferred from another department to undertake work on the special order. They are fully occupied in their usual department, and subcontracting staff would have to be brought in to undertake the work left behind. Sorry. Subcontracting cost will be $32,000 for the period of work. I hope you got that well. There are 2 employees who are specifically skilled for this job. The department they are already in, they are fully occupied. So if they are fully occupied in the department they are in, and we want to transfer them to this special job, whatever work they leave behind, they left behind, we must subcontract people to come and do the work they have left behind. And we will pay those people who we will subcontract our staff, moving them to the new job, $32,000. I hope you're getting the principle there very, very carefully. Then we are told that different subcontractors who are skilled in the special order techniques are available to work on the special order, and their cost would amount to $31,300. So what do we do? Should we use our existing staff to do the new job so that the work they leave behind, we will subcontract it at $32,000, or we let them remain in their work, and then we'll bring subcontractors to come and work on the special order for $31,300. So what is the relevant cost here? What do you think? Someone should put it in the comment box. Is it a 32,000 the relevant cost, or the 31,300? What do you think? Put it in the chat box. Let me see. Charles Zuli, I see you. You are welcome. Just give us a high five also. Or clapping also. It's an emoji in the chat box. Yes. Who is giving me the relevant cost? Is it the $32,000 or the $31,300? Which one will be the relevant cost? Would you use your own employees, and then whatever job they leave behind, you employ new people to do the job at $32,000, or you subcontract the special order at $31,300? Ignatius Entry, I see you. Hello, you are welcome. So the relevant cost here is always the lowest cost of the two options. For that reason, when it comes to the direct wages, our relevant cost is going to be what? The 31,300. I hope it makes sense. So the relevant cost is going to be the 31,300. Very, very important. You see how we go about it? Okay, so Charles Zuli has also put it in the chat box, 31,300. So on our first cost item, we will say the direct wages is gonna be, and that'll be note one, and that'll be 31,300. Makes sense? Now, so you need to explain why it is the 31,300. So that is where the notes comes in. So Bernard Kwabena, I see you as well. You are welcome. So why are we saying is the 31,300? That is the explanation we need to give in relation to that. So let me see. So I'm gonna write one or two for you guys, and then you see how we go about it. So remember we have our cost sheets like pro forma already. So here it's our notes. So the notes one. So this is how we write it out. So remember I told you items will be here, notes will be in the middle, and then the currency sign will be here. So when it comes to the direct wages, that will be note one, and we'll write there 31,500. Make sense? So the note will be an explanation of why it is 31,500. So why is it 31,500? So we say that the relevant cost is 31,500. The sub 31,500. The sub subcontractors for the special order. Okay, since that is the lowest cost in relation to that. Hi, Samuel Quasin, I see you. You are welcome. Okay, so that is a sample of the note, right? So we say the relevant, I didn't bring the cost. Let me inject it here. So the relevant cost is 31,500. The subcontractors for the special order, since this is the lowest cost, done using our own staff in relation to that. So that is the first one. And in every question or in every footnote, we are going to be writing this English down. Are you getting it? So the English, some you won't write English, you will just do workings. But in this context, there is no workings to be done. So we will write an English down. So you don't just get up and say, oh, the revised cost is this. So the direct wages should be 31,500. Why? Is it 31,500 or 31,300? I think it's 31,300. So that is the relevant cost in relation to that. All right. And that's the first cost item. So you have your pro forma there, put them down, and let's go to the note 2. Right, so if you are watching, if you have any questions, feel free to put it in the chat box. I'm reading all of your comments in real time, and I'll be replying to all of your comments. We are looking at relevant costing, and certainly after that, we'll be looking at something under short-term decision in relation to that. Okay, so let's go back to the question again, and then let's see how we go about it. So that's the first item, direct wages. You see, this one is not too difficult, right? It's direct. Let's go. So let's look at the notes too. The second item in the cost is supervisor's cost. So look at it. You realize that in the direct wages, the inexperienced accountant did 28,500. But when we use relevant costing principle, it's supposed to be 31,300. So you see the error she did. Now, supervisor's cost. I want you to pay close attention to this one because it's very, very technical. So let's go through it. Supervisor's cost is in note 2, and the inexperienced accountant has recorded 11,500. But let's go to the notes 2 and let's look at the details of what we have there. So that's the notes 2, the supervisor's cost. A supervisor would have to work on the special order. The cost of 11,500 is comprised of $8,000 normal payment plus 3,500 additional bonus for working on the special order. Let me take that again. And I want you to pay close attention because when I finish, I want you to put it in the chat box. I want you to put the relevant cost in the chat box for me. A supervisor would have to work on the special order. The cost of 11,500 is comprised of $8,000 normal payment plus 3,500 additional bonus for working on the special order. Additional bonus for working on the special order. Normal payments refer to the fixed salary of the supervisor. In addition, the supervisor would lose incentive payments in his normal work amounting to 2,500. It is not anticipated that any replacement cost relating to the supervisor's work on other jobs would arise. So what is the relevant cost here? Charles Zuli, the first one, you got it. Who will give me the relevant cost here? What do you think is the relevant cost here? The inexperienced accountant said it's 11,300. But if we get a breakdown of the question carefully, 8,000 of that is his normal salary. Now, normal salary means whether he works on this job or he doesn't work on this job, he's going to get that. So off the bat, $8,000 is an irrelevant cost. I hope it makes sense. The $8,000 is an irrelevant cost. Plus, he's going to be receiving $3,500 additional bonus for working on the special order. So we are told the normal payments refer to the fixed salary of the supervisor. In addition, the supervisor will lose incentive payments in his normal work amounting to $2,500. It is not anticipated that any replacement cost to the supervisor's work on the other jobs will arise. Okay, I see some answers in the chat box. Charles Brimer said 6,000. Charles, how did you get 6,000? I guess you were adding his additional bonus and then his lost bonus. That is wrong, Charles, but that's a good try. You can try again. Charles Zuli said 3,500 is the relevant cost. That is also wrong. So Charles, okay, you are all Charles. Okay, so Charles Brimer, 6,000 is wrong. Charles Zuli, 3,500 is wrong. Who is trying again? Listen to the question carefully. You know, I told you the English is very, very important. So let me help you out. On this job, he is receiving 3,500 as his bonus. Now, had it not worked on this job to receive a bonus of 3,500, his normal bonus is 2,500. So the 2,500 we are seeing here, we are told is his bonus that he will be getting from his normal work. So if not for this contract, he would receive his fixed salary of $8,000 and he will receive his bonus of 2,500. But on this job, he won't get that bonus on the previous job of 2,500, but now he's getting a bonus of 3,500. So if you check, the relevant cost here will be the incremental bonus. All right, Charles Zuli, you got it, $1,000. So the relevant cost here is going to be $1,000. The extra bonus he's earning for working on this job. I hope you are seeing how it is. Very, very simple. Very, very simple, right? But if you don't read the question well, you're going to screw it up. And that is why man accounting, relevant costing, it's interesting. So Charles Zuli, that is correct, $1,000. So the relevant cost here is $1,000. So add that to your cost sheet, and in the note segment indicates that the relevant cost is $1,000. That is the additional bonus that he is going to be earning for working on this special order. So that is the relevant cost there in relation to that. Hope you see it. So the inexperienced accountant was just thinking about the fact that, oh, we paid the person $8,000. He receives a bonus of 2,500, or we paid a person 8,000 and then he receives a bonus of 3,500. So the relevant cost should be 11,500. No, the relevant cost here is $1,000. Charles Brimer, I hope you understand. You got 6,000 earlier. I hope you understand that it is 1,000. So it is the additional bonus he is earning. Because if he is working on his previous job, he will still get his bonus of 2,500. So that is a sunk cost. So the additional cost the company will incur for bringing this supervisor on the new job is the additional bonus of $1,000 that we are paying him. So go to your cost sheet and work it out. Okay, go to your cost sheet and work it out. So supervisor's cost, that's note 2, and that is $1,000. So in the note aspect, we say that the relevant cost is $1,000. The incremental bonus the supervisor earns for working on the special order. The relevant cost is $1,000. The incremental bonus earned by the supervisor for working on the special order. So Charles Brimer said, I understand now. All right, that is awesome. That is awesome. So let's move on to the third item. And the third item is general overheads. Now, if you remember carefully, we mentioned that general overheads are irrelevant costs. Do you remember that? So the third cost item there is general overheads. And the inexperienced accountant has put there $4,000. But let's go to the footnotes or the notes and let's read what's happening on general overheads. So note 3, general overheads. General overheads, and you are going to be answering this one also, okay? So make sure you get it. General overheads comprise an apportionment of $3,000 plus an estimate of $1,000 incremental overheads. So what is the relevant cost here for the general overheads? General overhead, the inexperienced accountant puts there 4,000, meaning the apportion of 3,000 and then the estimate of 1,000 incremental overheads. So what is the relevant cost here when it comes to the general overheads and why? Who is giving a shot? Okay. Bernard Peho said $1,000. John Edu said the irrelevant cost is incremental cost of 1,000. And then Augustine also said incremental amount considered. Yeah, that's true. So you're all correct. So the relevant cost here is going to be the $1,000. That is the incremental overheads. The general overheads absorb of $3,000. That is an irrelevant cost in relation to that. I hope it makes sense. So go to your cost sheet and then you put the general overheads note 3, and then you put 1,000 under the currency column. Then in your notes column, you explain that the relevant cost of general overheads is the estimate of $1,000 incremental overheads. I hope it makes sense. So let's go to this fourth note. The fourth item is machine depreciation. Remember, we said depreciation is also irrelevant cash flow. But let's see the footnote, what actually that item constitutes. The inexperienced accountant has written there that the machine depreciation is 2,300. So let's go to the note 4 and let's see what's happening there. Machine depreciation represents the normal period cost based on the duration of the contract. It is anticipated that $500 will be incurred in additional machine maintenance costs. Machine depreciation represents the normal period cost based on the duration of the contract. It is anticipated that $500 will be incurred in additional maintenance costs. So what is the relevant cost here? Who is giving a shot? What will be our relevant cost? Master's hand. Remember, the inexperienced accountant wrote 2,300. Okay, so I see Bernard Peho said $500. Okay. Augustine said $500. John Edu also said $500. Charles Zuli said $1,000. Okay, I guess you are referring to the previous one. So yes, the relevant cost for the general overheads or machine depreciation, that's the note 4, machine depreciation, it's 500. So you write it down. So go to your cost sheet, machine depreciation, note 4, $500 in relation to that. Then you go to your notes column. Why is it the relevant cost? We say that the relevant cost for the machine depreciation is the additional machine maintenance cost of $500. Does it make sense? So that is the note we write for the fourth cost item. So let's go. Note 5, machine overheads. That's note 5. The inexperienced accountant has written there $18,000. And I want you to pay close attention to this one very, very well, okay? So pay close attention to this one very, very well. Okay, so Augustine said because it's future cash flow too. Yes, it's an anticipated cost, so it's a future cash flow. Let's look at the machine overheads, note 5. Like I said, pay close attention here and make sure you get it. Machine overheads for running costs such as electricity are charged at $3 per hour. Are charged at $3 per hour. It is estimated that 6,000 hours will be needed for the special order. it is estimated that 6,000 hours will be needed for the special order. The machine has 4,000 hours available capacity. So to do this work, there is electricity cost or electricity running cost of $3 per hour. We need 6,000 hours for this job, but we are told that the machine capacity is 4,000 hours. Follow me carefully on this one. The further 2,000 hours required will mean an existing job is taken off the machine, resulting in a lost contribution of $2 per hour. So, what is the relevant cost here? Read it carefully and make sure you understand what's happening here. Machine overheads for running costs, such as electricity, are charged at $3 per hour. It is anticipated that 6,000 hours will be needed for the special order. The machine has 4,000 hours available capacity. The further 2,000 hours required will mean an existing job is taken off the machine, resulting in a lost contribution of $2 per hour. So what is the relevant cost here? What is the relevant cost here? Pastor Sand? I'm doing my workings also here. Who is giving us an answer? Okay, so I got my answers down. Okay, so I see an answer coming from Bernard Peho. He said $3 by 2,000 hours plus $2 at 2 hours. Sorry, at $2. Bernard, your answer is partly wrong. The 3 by $2,000 is wrong. But the second aspect, 2,000 by 2, it's correct. Augustine said the lost contribution, which is $4,000. Augustine, that is partly true. That is partly true. The lost contribution is a relevant cost, but that is not the only thing there. Bernard Peho, you also have the second aspect, the lost contribution, that is correct, but the first aspect is wrong. Okay, Bernard said thank you. So what is the relevant cost here? Listen carefully. Charles Zuli said $2 by 2,000 hours, $4,000. Yes, that is the lost contribution, but that is not the full, or that is not all the relevant cost. You guys are getting the opportunity cost aspect, but the actual cost aspect, you aren't getting it. Now, the machine needs 6,000 hours to work. Does it make sense? So the machine will be running for 6,000 hours. We need 6,000 hours for this job. So for electricity bill, we are going to be paying $3 per hour by the 6,000 hours. So the machine running cost, Bernard said Then the first part will be 4,000 hours by 3. No, Bernard, it has to be 6,000 hours. Why 6,000 hours? Because we need 6,000 hours for this job. So when it comes to the electricity bill, we'll be paying for 6,000 hours. So the electricity bill will be 6,000 hours times 3, and that is going to give me $18,000. Then the lost contribution, which is the opportunity cost, 2 by the $2,000 will also come in. So when we add the two up, my relevant cost will be $22,000. Do you understand it? So Bernard, the first aspect is supposed to be 6,000 by 3. So because we need 6,000 hours. Zuli, you didn't bring the first aspect. Augustine, you didn't bring the first aspect. So I believe you understand now. So the relevant cost is going to be $22,000. Okay, so Bernard said, nice, nice. That was a tricky one there. Yes, that is why you got to read the question carefully and understand the concepts. All right. So our answer will be $22,000. The machine will be needed for 6,000 hours. So we'll be paying electricity bill for the whole 6,000 hours. Does it make sense? Then because we are stopping an existing job to finish with the job, we will be stopping the existing job for 2,000 hours. So that 2,000 hours is $2 per hour, and that will be the lost contribution, and that's the opportunity cost. So that is it. Augustine said, isn't 6,000 hours already existing information? If you say already existing information, Augustine, what do you mean? The special order needs 6,000 hours. Okay, so we will be paying running cost for electricity on the special order for 6,000 hours. That is why the running cost for electricity, 6,000 by 3, has to be brought. Then the opportunity cost, the lost contribution, $2 per hour by the number of hours we are stopping the existing job, also comes in relation to that. So Augustine, the 6,000 hours is the hours we need for this week. For that reason, we will be paying the electricity bill for 6,000 hours in relation to that. I hope it is clear. So that is note 5. You know, I told you this one is a tricky one. So you make sure you understand the concept. So go to your course sheet, put the 22,000 there, and then in your notes, you do the workings. You say machine overhead will be 6,000 times 3, and that's 18,000. And then the opportunity cost or the lost contribution 2 by 2,000, and that is also 4,000. So you add the two up, and that gives us $22,000. Okay, so let's go to the note 6. This is also a tricky one, so make sure you get it. So materials, note 6. The inexperienced accountant, okay, so Augustine said, yeah, I got it now. It's specifically stated for the special order. Yes, it is specifically stated for the special order. So materials, please be careful about this one too. It's a bit tricky here also. So stay with me and be alert. So the inexperienced accountant has written there 34,000, but you know she's always wrong. So let's go to the notes and let's look at note 6. You good? Let's see. Materials represent the purchase cost of 7,500 kilograms bought sometime ago. Listen carefully. Materials represent the purchase cost of 7,500 kilograms bought some time ago. The materials are no longer used and are unlikely to be wanted in the future except on the special order, and are unlikely to be wanted in the future except on the special order. The complete inventory of materials amounting to 10,000 kilograms or parts thereof could be sold for $4.2 per kilogram. The replacement cost of materials used or for material use will be 33,375. What is the relevant cost here? Let's take it again. Okay, so Bernard is asking a question, I think still about the machine overhead. He said, sir, please, why is it not 2,000 by 3? Yeah, the reason why, like I said, it's not 2,000 by 3 is that this job needs 6,000 hours, okay? This job needs 6,000 hours. So since it needs 6,000 hours, we will be paying electricity bill on this job for 6,000 hours and not for 2,000 hours. The 2,000 hours is the lost contribution because we'll be stopping one job for 2,000 hours. But for this job, we need 6,000 hours. And that 6,000 hours, we'll be paying electricity bill at $3 per hour. That is why it will be the 6,000 times $3 per hour. Bernard, I believe you are okay now. So it is the hours we need multiplied by the electricity rate per hour. The contribution is coming in because of the stopping or the stoppage of that existing job in relation to that. Yeah, referring to note 5, that's what I'm explaining to you. So it's always got to be the hours we need. So it will be 6,000 by 3. So Bernard, are you okay now? Let me know if you get the explanation now. Bernard, are you good? Okay. So note 6, who has the relevant cost for note 6? The material. What is the relevant cost? So materials represents the purchase cost of 7,500 kilogram bought some time ago. So remember, the inventory is bought. Okay. John Edu said the relevant cost of material is 31,500. John, how did you get that? Let me see if I think that is what you did. Yeah, John, that is correct. Tell me what you did. Bernard said, Bernard Peho said 33,375. No, Bernard Peho, the replacement cost cannot be the relevant cost because look at it. Let's read the question very well. Materials are no longer used. Augustine also said the replacement cost. No, the replacement cost cannot be the relevant cost. Let's read it well. Let's read it well. We are told that the materials are no longer used. and are unlikely to be used or to be wanted in the future, except on the special order. Okay, so John said 7,500 by the selling price. That's correct. Charles Zuli also said 33,375. That is the replacement cost. That is still wrong. The materials are no longer used. Okay, so the company will not use it for anything. So if we use it for this job, we don't have to replace it. If the materials are in constant use, that is where we would, when we use it for this job, we have to replace it. But because it is no longer in use or needed by the company, either now or in the future, the replacement cost is irrelevant. So the relevant cost here will be the opportunity cost. That is the lost sales that we will have, because we are told that it can be sold for $4.2 per kilogram. So John Edu is correct. So the relevant cost here is going to be the 7,500 multiplied by the 4.2, and that gives us 31,500. That is the relevant cost, because the relevant cost here becomes the opportunity cost, the lost revenue. If we use it for this job, we cannot sell it. For that reason, it becomes the opportunity cost. So that is the concept about that. I believe you understand. Augustine, Bernard Peho, Charles Zuli, I believe you understand the concept. So the replacement cost cannot be the relevant cost, because um, the materials are not in constant use. So go to your cost sheet, materials, note 6, and then you write there 31,500, and at the working side or the load side, you indicate there that the relevant cost is the lost contribution or the opportunity cost, which is going to be 7,500 kilogram multiplied by 4.2. Okay, so Bernard Peho said, I got it now. Right, that's awesome. Okay, so from the cost sheets that the inexperienced accountant prepared, it looks like we are done. But there is an additional information there that we need to take care of. So look at the additional information. Let me highlight it for you guys. Okay, so Grace, a CIMA, said the relevant cost is 31,500. Yes, it's 31,500. That is 7,500 by 4.2. If you are watching, give us a thumbs up on the video, and that way it gets more engagement, and that is how YouTube will be able to push the video to other people so others can watch and we can together grow the channel. And if you have not subscribed to the channel also, come on now, hit on the subscribe button and hit the notification bell so that when we go live and we release new content, you'll be the first person to be notified as a VIP member of the channel in relation to that. So let's look at the final information where I have marked. Because the business does not have adequate funds. Okay, so Charles Zuli said okay, and then Grace Esiama also said 7,500 by 4.2. So Charles Zuli said, then it will be 7,500 times 4.2. Yes, that is the answer, 31,500. So let's get a final note. Because the business does not have adequate funds to finance the special order, a bank overdraft amounting to $20,000 would be required for the project during for the project duration of 3 months. Let me take that again. Because the business does not have adequate funds to finance the special order, a bank overdraft amounting to $20,000 would be required for the project duration of 3 months. The overdraft would be repaid at the end of the period. The bank's overdraft rate is 18%. The bank's overdraft rate is 18%. So what is the relevant cost there? The company per se limited doesn't have enough funds. So we'll have to go for a bank overdraft for 3 months, $20,000, paying an interest of 18%. So interest, sorry. So what's the relevant cost there? Fastest and what do you think is the relevant cost here? Bernard Pejo said the overdraft plus interest on the overdraft will be relevant. Bernard, why? Can you explain? Then John Edu also said finance cost of 360 is the relevant cost. John, how did you get 360? Can you explain? And then Bernard, why is it the overdraft plus the interest on the overdraft? Why should the overdraft be a relevant cost? So here, the relevant cost is the interest on the overdraft. The overdraft itself is not a relevant cost. It is the interest expenses we are incurring that will be the relevant cost. Because the overdraft will be repaid. But what is the incremental cost we are going to be incurring because of the project? It is the interest expenses in relation to that. So Bernard said, because the overdraft is specified or specifically for the project or specific to the project. Okay, so Bernard, the relevant cost here is only the interest expenses. The overdraft facility itself is not a relevant cost. It is only the interest payable on the overdraft that will be a relevant cost. So Augustine said $900. Yes, so that is the relevant cost. So you go to your cost sheet and you write the finance cost, note 7, and that's 900, and then you do the workings at note 7. John Edu, how did you get 360? What did you do? John, maybe you didn't punch well. It's 3 months, so it's supposed to be 20,000 times 18% times 3 over 12. Times 3 over 12. So Charles Zuli said 20,000 plus, okay. So Charles, the overdraft itself is not part. Remember, the overdraft is not for a whole year. It is just for the project duration of 3 months. So it is only the interest that will come in, 20,000 times 18% times 3 over 12. So the overdraft is not a relevant cost because we will pay it back. The additional cost we are incurring, it's the interest expenses on the overdraft. So Charles Zuli, I hope you get the explanation. It's supposed to be 900. And then Bernard said, well noted. Thanks. You are welcome. So now we are done with everything. I believe you see how the question is structured. This is a full relevant costing question, and this is something similar that the examiner is going to be throwing at you in the exam hall. So if you don't read the question carefully, okay, so John Edu said, yes, I punched wrongly. All right. So if you don't read a question carefully and identify what is really happening and the fundamental principles, you're going to screw up. I hope you're getting it. So make sure you take time, go over this question again, and then solve more questions as well to build your understanding very well. So let's see the course sheet together. So this is how my course sheet is after I'm done. Or cost card. Let's write cost card. Yes, this sound a bit better. So my currency here, my notes here, and then my item here. Okay. So the first item was direct wages. That was note 1. We got 31,300. The second item was supervisor's cost. That's note 2. We got 1,000. The third item was general overheads, and that is note 3. And we got 1,000 there also. The fourth one is machine overheads. That's note 4. And we got 500. The fifth item was, okay, the fourth item is machine depreciation rather. It is the fifth item that is machine overheads, note 5. And I think we got 22,000. And then we come to material, that's note 6. We got 31,500, the lost contribution. And then the final thing was the finance cost. That's note 7, and we got 900. So let's add it up. What do we get for our revised costs based on standard costing? So what do we have? So let's add it up. I think we should have something like 88,300 or so. Let me just punch mine out as well. 88,200, okay. Okay. So that is the relevant cost, 88,200. So this is how we determine the relevant cost of a special order. And this is what the examiner is likely to throw at you. And for 10, 15 marks, the examiner may ask you a question like this. Like I told you, don't just prepare this course sheet. The notes are very important because the notes are the working area where you are determining what is the relevant cost and what is the irrelevant cost. So any questions, please? Any questions? If you have any questions about this or any observations, you can put it in the chat box. I'm going to be answering all of them. Okay. So that's about relevance costing. So let's go to the second thing I want to discuss with you today, and then we'll be running up on that. And that is going to be a shutdown decision. You see, one of the things that businesses do in the short term is make a lot of decisions in the short term. And relevance costing is actually part of the short-term decision making principle. And then shutdown decision is also a relevant cost. So let's go to short-term decisions and let's look at shutdown decision. So how do we make that decision? So shutdown decision. That's the next one we want to look at. So why did I take this? Because this is one of the fundamental short-term decisions and has a key principle that the examiner would throw at you in relation to that. Now, the question is, why will a company decide to shut down a division, shut down a production line, or shut down a whole subsidiary? Why? Usually, companies will make such decisions because they realize that if they look at the financial statement of that production line, that department, that division, or that particular subsidiary, it is a loss-making product or production line or segment of the business. So it's a loss making. So if it is a loss making, then the business will make a decision that, hey, let's shut it down because other production lines are making profit, but this one alone is making a loss. For that reason, let's shut it down. But you see, as management accountants, that's why we are there. So we will assist management so they don't just look at the face of the financial statement and make a decision that will actually cost the organization. For that reason, we need to bring in the relevant costing principles and find out what factors do we take into consideration before shutting down the production line, before shutting down the division in relation to that. So in the making of the shutdown decision, we need to look at the relevant cost by comparing. This is the principle, and I want you to understand this carefully. So we compare the foregone revenue or foregone contribution against, or we compare it with the avoidable cost. Listen to me carefully. In the making of shutdown decision, we compare foregone revenue against avoidable cost. I believe you remember what is avoidable cost. Avoidable cost is the cost savings, the cost we will no longer incur should we shut down that division, should we shut down that process, should we shut down that production line. That is the avoidable cost. The foregone revenue is the revenue that we're going to be losing, the opportunity cost, should we shut down that division. So in a nutshell, the avoidable cost will entail two things. Number one, the marginal cost or the variable cost, marginal cost or variable cost, as well as specific fixed costs. So we compare the avoidable cost with the foregone revenue or revenue contribution. That is how we make the decision. So what is the decision rule? If your foregone revenue is greater than the avoidable cost, then we don't shut down the division. Because for instance, if you will be losing a revenue of say $20,000 when you shut down the division, okay, and when you shut down the division, you can only save maybe $15,000. That's the avoidable cost. Will you shut it down? No, because when you shut it down, you are losing more revenue than you are saving yourself in relation to that. So if the foregone revenue is greater than the avoidable cost, we don't shut down the division. However, the reverse is true. If the avoidable cost is more than the foregone revenue, then ultimately we shut down the division in relation to that. So if, for instance, if we shut it down, we're going to be saving about $32,000. But if we shut it down, we're going to be losing a revenue of, let's say, 18,200. In that case, we are saving a lot. Should we shut it down? And so we shut it down in relation to that. This is what we mean by shutdown decision. Any questions, please put it in the chat box. Any questions? But remember that apart from making or doing those workings, you don't just shut it down. So it's a loss making. It could be that yes, the avoidable cost will be more than foregone revenue, but this is just a starting point because we have to take into consideration what other factors before ultimately shutting it down. Because the shutdown may affect the demand of other products. Because if there are products that are jointly demanded, okay, or there are products that are complementary products, okay, or there are products that people buy together when they come, then when we stop selling that product or we shut down, it could affect the demand of the others, of the other products. So we have to check whether we have to check whether the shutting down of that division may affect the demand of other products. It's a factor we need to consider. Number two, we have to also consider the morale of the staff. Because remember, you are in a company, you are all together, then you have various divisions. Then you all go to break, you all have fun. Then all of a sudden, the company shut down one division and lay off the employees. Okay, what will you do? Your morale will be affected because you'll be thinking that, hey, we're more shutting down. No? That means we are next. Are you getting the idea? So shutting down a division, shutting down a production line, shutting down a segment of a business could also affect the morale of employees. We need to also factor that into it in relation to that. Then we need to also take into consideration any redundancy cost as well. Because if you shut down the division, probably you're going to be incurring cost and redundancy, all right? You are laying off people, then you have to give them maybe 3 months salary or 4 months salary. In that case, well, how do you do that? You are laying them off, whatever pension due them, you need to pay it to them. Do you have the money to clear all of that by shutting down the division? So redundancy cost, we must consider that one as well. Then any contract we have with suppliers or customers of that particular process, division or department of the organization that we are considering shutting down, we must also take that into consideration. Because if you have a contract with a supplier, 5 years contract, and when you cancel the contract, you are supposed to pay a penalty. That means if you decide to shut it down because you are looking at the avoidable cost and the foregone revenue, then you will be paying that penalty. And if the penalty is very high, then probably it may not be a good decision to actually shut it down in relation to that. So this is the first workings we do. Aside that, we have to look at the impact of the shutdown on the demand of other products. We have to look at the morale of staff, the impact of the shutdown on the morale of staff. We need to look at the issue about redundancy cost, and we have to look at any contract that the entity has with suppliers or customers, and should shutdown result into the payment of any penalty, will we be able to settle it in relation to that? So these are what you need to understand when we talk about the issue about shutdown decision. Any questions? Put them in the chat box real quick. Any questions for me? I believe you get a principle there very well. All right, so let's look at a question on that. Let me share my screen. I think shutdown decision, it's above. Okay, so this is the question on shutdown. So you can take a snapshot or something like that. Shutdown decision. A company has two production lines and its management accounts show the following. So we have production line A, production line B. Augustine said, I think a future comeback cost should also be considered. Okay, okay. That is, should we shut it down now and maybe something good, or there is a better prospect in the future, or there is an improvement in the economy and we are trying to bring back that division or that segment, how much cost we're going to be incurring in relation to that? Okay, so yes, that is something the entity can consider in relation to that. So we have the production line A, production line B. We have revenue 2830, marginal cost, which is the same as variable cost, 12 and $20 million respectively. Then we have the fixed cost, 10 and 14. Then we see total cost 22 million and then 34 million respectively for the production line A and B. So we see profit or loss. So we see that production line A is making a profit of $6, whilst production line B is making a loss. So just from the pro forma there, we know that the company is considering shutting down line B. So let's see, the total fixed cost of 24 million has been apportioned to each production line on the basis of the floor area, floor space rather, occupied by each line in the factory. The company is concerned about the loss that is reported by production line B and is considering closing down that line. Closing down either production line would save 25% of the total fixed costs required. Should the company close down production line B? Should the company close down production line B? So what's happening here? Production line B is making a loss of $4 million. But we are told that should any of the lines be shut down, that is the production line be shut down, the entity will save 25% of the total fixed cost, which is the $24 million in relation to that. So what did we say was the decision rule? We said that we compare the foregone revenue. So if you check here, you realize that the revenue of production line B is $30 million. If we shut it down, we are not going to get that. Good. Then we look at the marginal cost of production line B is $20 million. Then the specific fixed cost, that is the fixed cost savings, should we shut it down, will be 25% of 24. And that should be 6, I guess. Yeah, $6. So we are foregoing a revenue of $30 million, but we will be saving ourselves the marginal cost of 20, and then the fixed cost of $6, meaning that the avoidable cost becomes how much? 26. So if you compare, do you shut down or you don't shut down? You realize that the foregone revenue is greater than the avoidable cost. So we say that the company cannot shut down the production line B. That's the answer to the question. So let's put it down. So two things, foregone revenue against the avoidable cost. So we are told that the foregone revenue is $30 million. The avoidable cost includes the marginal cost of 20 million, and then the specific fixed cost, which is going to be 25% of the $24 million, and that's going to be 6 million. So we add it up, and that's going to be $26 million. Okay, $26 million. So we compare. So you realize that the foregone revenue is greater than the avoidable fixed cost. So we say that the entity should not shut down production department B. That is the answer to the question. Okay. So that is the answer to the question in relation to that. So when it comes to shutdown decision also, this is how we go about it. You compare your foregone revenue against your avoidable cost in relation to that. I hope you get an explanation. Any questions, any comments, you can put it in the chat box. I'm gonna read them for you. Okay. So this is what you got to understand when we talk about relevant costing as well as shutdown decisions. Relevant costing as well as shutdown decision. Remember that when it comes to short-term decision making, the principles run through in relation to that. So if you have any comments, you put it in the chat box. I'm going to be answering all of them. Okay. So I'm going to conclude here today for our lectures. And thank you very much for joining the stream. Today as well, we are looking at the Executive Revision Masterclass with me this week, and we're focusing on some key aspects of the syllabus. So God willing, tomorrow we're going to be looking at financial reporting and corporate reporting, and we're going to be looking at the financial reporting standards, the IASs and the IFRSs. So that's what we're going to be looking at tomorrow. So for those of you who are doing financial reporting and corporate reporting, I'll be taking you guys through the accounting standards, and I'll be answering questions from you guys as well on the various accounting standards that you don't understand or that you may have problem with. So you can inform your colleagues about it. Same time tomorrow, 4:30 p.m. I'll be live here, and we will be looking at the accounting standards in relation to that Okay, so that is what we're going to be looking at tomorrow: financial reporting or corporate reporting, accounting standards. When it comes to these two subjects, that is financial reporting, corporate reporting, one of the critical areas is the financial reporting standards. So tomorrow we'll be live here with that, and we'll continue with our discussion with that. Bernard Corbiner said, please. Okay, so Bernard, you have any questions? Thank you. May God bless you. Okay, so John Edu said, thank you. May God bless you. Amen. God bless you too, John. So thank you guys for joining the stream and always taking time to join us. Augustine, John Edu, Richard AJ, Charles Zuli, Ignatius Entry, Bernard Kobena, Samuel Quasin, Charles Brima, Bernard Peho, and all of you guys. Thank you very much. Grace, CIMA, and all of you guys. Thank you very much for joining. And Bernard said, why is the 25% not calculated on the 14 million of the line B? Okay, Bernard, because we are told that when the company shuts down any of the decisions or any of the divisions, the entity will save 25% of the total fixed cost. Okay, 25% of the total fixed cost. Let me share that with you so that you see. Look at it. It said closing down either production line would save 25% of the total fixed cost. I getting it? So because it says 25% of the total fixed cost, that is what will be saved. That is why we will do that. So assuming that statement was not made, then we would have done 25% of the department or production line B's 14. So we are doing 25% on the total fixed cost because that is the policy of the organization. Okay, so Damilari Owulabi also said, thank you, sir. You are welcome. So thank you guys for joining me all the time. It's always a privilege coming your way and being able to assist you for you to prepare well for your examination. And it's my objective that these sessions that we are having will actually add value to you and help you to be able to prepare well for your examination as we wait on new dates from the ICA, from the ICAN, and from other institutions as well as this coronavirus continues to cause havoc around the world. But we're hoping that everything will come back to normal. But like I say all the time, it is a time for you to upgrade yourself, work on yourself, and become a better version of yourself as an individual in relation to that. So don't slack, don't be lazy, don't sit down, don't just be watching movies and doing other things. Make sure you are always adding value to yourself and you are doing something great that will position you for the next level in relation to that. So thank you very much for joining the stream. I'll see you same time tomorrow, 4:30 p.m. and we'll be looking at the financial reporting standards. So we are focusing on corporate reporting and then financial reporting in relation to that. So thank you very much for all those of you who joined the stream. Thank you for the thumbs up. Thank you for sharing the videos as well with others. And remember to subscribe to the channel to stay connected. And also remember to share it with your friends. We want to grow the channel and be able to reach as much people as possible. So I will be grateful if you assist us with sharing of the contents of the channel to your friends, your colleagues, and loved ones. So we get a lot of people coming on and assisting a lot of people together. Because if you become successful, I am successful, everyone is successful, the burden will be reduced. But if I'm the only person who is successful or you're the only person who is successful, you will struggle I will struggle in relation to that. So together, let's build this community up where people can come in and they will get answers to their questions in relation to that. Right, Augustine, good night and stay blessed. So bye-bye, and I'll see you same time tomorrow. All right, Charles, God bless you too.